I think the way to think about it is let's realize in 23, we came in short, bearish, and expecting the worst. And in 24, we came in long, bullish, and expecting the best. And I think what's happening right now is that markets are pushing back against that narrative, as are we. I think there's going to be a lot of opportunity this year. We can talk about the playbook in a little bit, but there is a wide range of outcomes that could happen with equities. I mean, you can see a scenario where the Fed engineers a soft landing and we get to the 5,200 that Tom Lee's talking about. That's nirvana. Has to be near perfection.
That's kind of the top end of your range, too, in the best case scenario for your outlook for this year, right?
That is. And everything has to go right in that scenario. We suspect, though, that we're going to be challenged throughout the year. I think what we say is we're data dependent. So we're hanging on really every word, every data point to be able to see opportunities at the lower end of the range. So what we would tell our clients is that we want to be mindful buyers if the market gives us that opportunity to do so. And we want to be pausers because we're long-term investors. There's no question about it. We're not selling when the market gets to the upper end of the range. We're undulating the accelerator and reacting accordingly. And I think now's the time to pause and see if it's a pause that refreshes. You know, the bond market's sending a lot of various signals, right? The 2 year specifically. And is it one of worry? Truth is, we don't know that yet.
I like that you bring it up that way. We don't know because, you know, does the strong economy, Jimmy, mean the Fed's going to cut less? Well, what if you don't believe the economy is as strong as a retail number would lead you to believe? Because some of the other data hasn't been all that strong at all. Then we start to think about, well, what about a policy mistake? Fed stays too tight for too long. It leads you to what Waller said yesterday. And remember, he's sort of emerged as this person within the Fed that, you know, he arguably caused this whole rally from the end of October until the end of the year. And he now seems to have put a little cold water on the rally over the last couple of days and caused this move higher in interest rates, where he says that policy is set properly. Those are quotes. That the Fed should lower rates, quote, methodically and carefully. No reason for the Fed to move as rapidly as in prior easing cycles. It goes to where I started. We're not really sure what's exactly happening and how the Fed's going to react to it. But the market has priced a lot of stuff in.
Yeah, and I think it's safe to say that we're not sure. I'm not waking up in the middle of the night worrying about the markets right now. I will acknowledge to everyone watching that this is a heavy tape right now. I mean, no question about it. This is a heavy tape. And I think that this is just simply an adjustment to the idea that we're not getting a rate cut in March. And we shouldn't have gotten a rate cut in March, but we're very likely to get one in May. And I think the market just simply got ahead of itself. But I do still commit to my overarching belief that this is a year in which earnings matter far more than the Fed. We're talking about when the Fed's going to cut, not if they're going to cut. We're talking about the Fed cutting, not how high are they going to continue to raise rates. And that's a complete tone change in which news like today about retail sales and industrial production coming in better than expected is good news. It pushes off further the idea that we're going to have a recession or a hard landing. Both of which, or excuse me, they're both the same way of saying that would impact earnings, which again is critical because if you want the rally to 5,100, Tom's at 5,200, but I'm at 5,100, you have to get that 12% earnings growth this year. So to the extent you got retail sales that says consumption is strong, employment is strong, that's what I'm looking for. I'm not worried about the market adjusting to the Fed now moving in May instead of March.
Yeah, but Ginny, one of the key issues, certainly one of the key questions is whether sentiment and valuation are offsides. On the sentiment issue where, you know, as Rob perfectly laid it out, how we came into last year and now how we've come into this year all bulled up on everything, right? Inflation's coming down, earnings are going to be good, economy's going to be strong, stock market's going to be good. Jamie Dimon was a little, maybe he said there was too much optimism in Davos. Let's listen.
I think it's a mistake to assume that everything's hunky-dory. And, you know, and when stock markets are up, it's kind of like this little drug we all feel. Like, it's just great, you know. But remember, we've had so much fiscal and monetary stimulation. So I'm a little more on the cautious side, that we are facing a lot of things in 24 or 25.
Is there too much optimism?
Yeah, I think so. And I don't think that it means we're in for a big crash or a huge retraction. So here's kind of the way my math works out on that. When you say, has that sentiment, has that enthusiasm pushed valuations off sides? So the way I look at it is, if we can get to consensus earnings, which is $247 a share, that's assuming 11% growth over last year. You put a 20 times multiple on that, that gets you to 4,900. You put a 18 times multiple on that, that gets you to 4,400. So I look at it like a range. If we can have Rob's perfect scenario, right? Everything goes great. I think we get to 4,900. That's up 4% and change from here. If we're kind of in valuations not being totally offsides, hovering at 18 times, that's down 7% from here. So I think it's offsides, but I think the magnitude this year should be more tame than what we've seen in the past 2 years. I mean, we're coming off of some crazy emotional swings, right? Thinking about 2022 with the market being down 18, last year with it being up 26. I kind of like where we are right now because we can point to anything, we can point to everything, anything, but I think the reality is we just need time to digest. And I think it's a pretty healthy, I would be thrilled if we end this year flat after a plus 26% year. So I think it's a healthy place to be in where we're not getting crazy with overly robust expectations.
What do you think about what Diamond said?
I think there are always concerns, whether it's geopolitical or economic. I think in 2024, yes, we have concerns. And I think one of those concerns is what you cited before, and that is ultimately what the direction of monetary policy is going to be. Are they going to make a mistake and stay too long? I think that's the risk, that they do stay too long. I also think when you take the totality of the first 17 calendar days of January, what's missing clearly to me is follow-through. Follow-through from where we were on Wednesday, December 27th, when a 10-year Treasury was 378, and we were talking about a 10-year Treasury falling to 3.50. You never got that follow-through. And Scott, because you didn't get the follow-through, once again, you're seeing that capital is frozen. You've talked to a lot of people in the asset management industry. They will tell you that a lot of the money that was in motion at the end of the year is once again frozen because you're challenged by a 10-year Treasury above 10%, and people are still sitting in those cash yielding equivalents.